Welcome to Unstoppable Real Estate Investing Wealth. My name is Billy Alvaro, aka the Unstoppable BA, former billion-dollar mortgage banker, gone bankrupt, turned professional real estate investor. Where each week you'll learn the tools, strategies, systems, and secrets myself and other highly successful real estate investing entrepreneurs use to start, grow, and scale their businesses, creating massive profits, and how you can too. And we'll teach you how to put those profits to work so you no longer have to. Get ready to finally experience financial freedom and generational wealth. Now let's get started. What's up, everybody? Welcome back to another show of Unstoppable REI Wealth. I am your host, the Unstoppable BA, Billy Alvaro, and I'm recording this today from sunny Puerto Rico, Camway. I'm here for a month, loving the whole virtual lifestyle. This is like incredible that you can just get away when you set up processes and systems and you have the right people in place, because you can go away. We travel about 3 months a year, and this is just, it's incredible what real estate can do for you and your lifestyle. And that brings me to today's guest, Miss Avery Call. Avery Call is the author of Short-Term Rentals, Long-Term Wealth. She goes short to go long. She's also the host of the Short-Term Show. Avery, welcome to the show. And first off, I want to apologize. I had to put you off last month when I had something to do. And I appreciate you coming on this month. Thank you so much.
Yeah, of course. No problem. Thank you for having me.
Well, welcome in. So listen, I love your story. I did some research on you. Only 5 years in the business and you have over 100 doors already?
Yeah, we're actually under contract on 69 more. So we'll be right at about 189 when everything closes.
I mean, I'm going to call you dude for a second. Dude, like, how are you doing? Like, share your secrets. I know you have two different strategies you're playing. You have the short-term game. I'm thinking that's an Airbnb. And then you have your long-term buy and hold rental. So, like, how did you do what you did in a short 5-year time frame?
Well, it was kind of by accident. 5 of our first 6 real estate investing purchases were short-term rentals. And because the short terms have traditionally or typically will cash flow so much higher than just a single family long-term, we were able to scale much more quickly than if we'd started with only single family long terms. And we kind of ended up on short terms out of necessity, really. So we bought our first long-term rental, and that was a great one, actually. The mortgage on that was like $650 a month. We were renting it for $1,500 a month. So not bad at all for a little single family. And after we got our first rent check on that, we said, okay, well, this is amazing. This is something that we want to actually make a business out of. And then we started educating ourselves and listening to podcasts and reading books. We just pulled the trigger on that first one without doing any research. And luckily it was a really good one. But so a big proponent of learning by doing, but definitely do more research than I did when I first started. But we had just a little bit of capital left. And so we said, well, what can we buy that will allow us to buy more of these things faster? Because we just had, I think, like maybe $30,000 left. And so we landed on short-term rentals, and we were living in Nashville at the time. And so we didn't want to do it there because the regulations are just terrible and they're always changing. So we didn't want to get ourselves in a pickle. So we said, well, where can we go buy a short-term rental where it's the normal thing for people to go to this place and stay in vacation homes or vacation rentals rather than hotels? So we had just come from a weekend camping trip in the Smoky Mountains. And we said, well, how about here? Looked at purchase prices. Everything looked good. And back then there weren't all the educators out there that there are now in terms of how to run a short-term rental remotely. So again, we kind of had to just teach ourselves how to do it. Pulled the trigger. The first one did really, really well. Scaled that to 5 of them over the course of about 18 months. And the rest is history.
My God. So I want to get in now because you gave a lot of information. First off, you mentioned regulation. What kind of regulations, if somebody's getting into this short-term rental business, what should they be looking for in their research when they go into a new market?
So you want to, and this is my strategy, it's not the right and only way. There are people that do things differently that are having just as much success. But my advice is to buy in regional, drivable vacation markets that have very little hotel presence. So areas like the Smoky Mountains in Tennessee or Destin, Florida, these are areas where the majority of the tourism that comes to the area is driving in. So regional tourism, not national tourism necessarily. And these are areas that don't have a lot of hotels. So everybody who comes to these areas, they're staying in short-term rentals. Like Destin, where I live, had vacation rentals before it had electricity. So because of that, the regulations in these areas are really, really established because vacation rentals have been around for a long time, decades and decades. They didn't just pop up as of the inception of Airbnb and VRBO. They've been around since before the internet. They've been around since before TV in a lot of cases. So the regulations are very established and favorable because there are not a lot of hotels to get mad that they're losing market share. Like in Nashville, for example, that's kind of what happened. Everyone who came on vacation to Nashville up until about like 10, 15 years ago were staying in hotels. Then all of a sudden Airbnb comes on the scene. All these investors are buying Airbnb properties, taking market share away from the hotels. Hotels are getting mad. And then bringing it up in city council meetings. Also, there's a lot in metro markets like that. There are a lot of primary homeowners who live in these markets who who their job does not depend on tourism. So even the primary homeowners in the regional drivable vacation markets, typically their business, if they're not retired, is dependent on tourism in some way. So they kind of understand like, well, this whole area is dependent on tourism. We're dependent on this. So I recommend sticking to the regional drivable vacation markets just because in most cases, there are exceptions to every rule. The regulations are going to be very, very well established. The cities and counties will have figured out how to monetize short terms decades ago to where it would be way too detrimental to the local economies to regulate against them now.
When you're going into a new market, do you contact the local municipalities to figure out what the regs are?
Absolutely. Yeah. You always want to, if it's a brand new market that you've never really researched, you always want to call the county or the city directly and see exactly what their regulations are. Don't just take other investors' word for it. Sometimes other investors are operating not within the rules. So obviously you want to network with other investors, but always get the regulations straight from the horse's mouth by calling the city or the county.
So is that your primary, because that leads me into another question about choosing your market. Is that the way in which you go about choosing the regional drivable type areas, or is there anything else that you want to add to that?
That's what I stick to. And so I grew up in Mississippi. So I started with areas that I was familiar with, that I came to with my parents growing up, where we stayed in a cabin or a condo or a beach house rather than a hotel. So that's kind of why I started in the Smokies. That's why I own stuff in Destin and 30A, Florida. But there are areas like that all over the country. So if you live in California, maybe it's Big Bear, or which has some regulations happening. Or if you're in New York, maybe it's the Poconos or the Catskills. So anybody can kind of think of those places. I would start there and then work into the regulations, because there are a lot of investors out there now that there's so much overeducation in the space happening that they're like, oh, I've never heard of this random place in Ohio, but this one or two people on some forum said they're doing really well there. So let me go see about that. And then they just jump in without really having any idea what's going on.
All right, so this is good. Any idea? I want to get into the next question, which is, how do you go about analyzing an Airbnb versus how you go about analyzing it for a long-term rental? Let's just stick with the Airbnb. I'll get into the long-term rental in a second. So what do you do for that? Like, what's the analysis look like?
So it's a very different process from analyzing a long-term or, a multifamily, where the rent is the rent and that's what it is every month, no matter who's managing it, until you do a major upgrade. It's very, very easy to analyze something like that. With short terms, a lot of times the success and the performance of the property will be more dependent on how it's managed than necessarily the property itself. So, for example, even if two people own the exact same property on the exact same street, everything about it is the same and they manage everything about it the same, except for one minor thing like minimum night stay. One person has a 7-night minimum night stay. The other person has a 3-night minimum night stay. The 3-night minimum night stay person is going to make more money just because they have less holes in their calendar. And that's just one little tweak. So with short terms, you have to look at as much market-wide data as possible and kind of average that out and then analyze. So there are several places you can get market-wide short-term rental data. So AirDNA is one. Rabbu, RABBU.com is another one. And then there is a tool called Price Labs that is a what you'll need. It's a pricing manager. It's what you'll need to price your property once you close on it. That actually has a pretty cool function called the market dashboards, where you can see like a 30-day snapshot of what properties have been doing. So you kind of have to pull market-wide data from a bunch of different places rather than just using the rental history, because in the grand scheme of things, the rental history of a property is just what one random property manager has been able to do with one random property. And if they're not managing it efficiently and they're not optimizing it, then that property won't be performing. So it's a much more involved process than long-term analysis.
Yeah, no doubt. And you said those three real quick, those tools that you use to analyze. One more time for listeners.
AirDNA, Rabu, and Price Labs market dashboards.
Price Labs market dashboards, all good stuff. Really, those are three good tools if you want to get into this business, guys. You want to start checking out if you're going to do short-term rentals. All right. So I understand now how to analyze. Here's a question that's coming into my mind. I know with regular long-term rentals, fix and flip, even apartment buildings, you can syndicate, you can raise private money. On the Airbnb, are you finding that you're going to private capital, or are there lenders out there who will actually finance the deal based off the cash flows that it could produce?
There are a number of ways you can finance. I always tell people, a lot of new investors, they start listening to a lot of podcasts and listen to investors who do this for a living, who are really, really experienced, who don't have any conventional loans left. So they are always going commercial or hard money or things like that. They're trying to do other things. I always tell new investors, like, if you can get conventional financing, knock out all those conventional loans that you get 10, by the way, knock those all out before you start going crazy with other types of financing, because there's never going to be better terms than conventional. And it's never going to be really easier to get a loan than conventional. There are products called DSCR loans. So that stands for debt service coverage ratio, that you're approved for that loan based off of what the property should be able to make, more similar to a commercial loan, whereas conventional, you're getting approved based on your own debt to income ratio. But what I see with a lot of new guys is that they'll say, oh, well, yeah, that DSCR sounds great, but the interest rate's really high. Well, yeah, of course it is, because the bank is giving you the loan basically on the idea that you're going to be able to manage it well. So I would say knock out all the conventionals that you have available to you first, unless you've got some sort of like a debt to income situation where you need to go commercial or portfolio. Knock those out first and then go for the commercial portfolio DSCR loans.
And so those commercial portfolio DSR, I know they're big into single family long-term, but they have them specifically for the Airbnbs as well?
There are a few companies that will do them. My mortgage company that I own, the mortgage shop, actually brokers to a few of them. And they will typically have a higher interest rate. They're typically 20% down, so you can't utilize that 10% down vacation home loan. There used to be several people who did the 15% down DSCR options, but those are they've gone awry without saying too much. So there's 20% options now. Typically the interest rate will be higher. And typically what I've seen with our real estate sales clients at the short-term shop is that the DSCR lenders will take at least 45, sometimes 60 days to close. So it can be a little bit difficult to get offers accepted with those types of timelines. But if you're able to meet those timelines, then by all means, DSCR is the way to go.
Yeah, I didn't know you were a mortgage person. Very cool. That was my whole background for years. Yeah, good stuff. So talk to me now about the markets that you're in, because when I reviewed everything, you're in Tennessee, you're in the Panhandle, you're in Omaha, you're in Alabama, like you're scattered. Is this where you have the majority of your short term, or is that where your long term rentals are?
So the short-term shop, my real estate team, brokerage team underneath EXP, they get mad at me if I don't say that. So we work exclusively with short-term rental investors. We're on track to hit about $1 billion in sales this year. We're in 11 regional drivable vacation markets. So 3 in North Carolina, 3 in Florida, the Smokies in Tennessee, Gulf Shores, Alabama, Blue Ridge, Georgia, Crystal Beach, Texas, and Oklahoma, Broken Bow, Oklahoma. I do not invest in long terms in the areas that I invest in short terms, because there are different types of markets that require different strategies. So I own short terms in the Smokies in Tennessee, Destin, Florida, 30A, Florida, and Cape San Blas, Florida. And then my long terms are in, I used to have several in Nashville. We cashed those out, 1031 exchange. We've got a bunch in Chattanooga, some in Alabama, and then our apartment buildings are in the Midwest. And really, the reason that we're in those markets are because we're familiar with them. So our Midwestern market in Nebraska, my husband's from there, so he's familiar with the streets and the areas and things like that. I would never try to short term any of my long terms. I like my long terms in medium sized metro markets where there's some growth happening with jobs. You know, I'm sure there's plenty of people who've been on here who talked about that. Yep. But my short terms are typically the vacation market. So it just wouldn't work purchase price wise. Like, you know, the average purchase price for a property in the Smoky Mountains is like $600,000 for a single family. Well, that's not going to work as a long term. So, and then I wouldn't try to short term any of my long-term properties because they're in metro markets and they're subject to the changing regulations from primary homeowners. So.
How are you self-managing, or do you have management companies doing this for you in the market you're in for the short term?
For long terms, we use management companies all day. For short terms, if you're truly trying to utilize them to grow your portfolio and really trying to bootstrap and scale, the really only way to go is to self-manage, because the average property management split in short term is about 25% typically. And some of them will even quote 25%, but it ends up being like 32% with added fees and stuff. So to give you guys an example of what that looks like, I've got 9 short-term rentals now. I had 8 of them last year, and 2 of them weren't even online for a full year. If I had paid a management company 25% of my gross last year, I would have paid someone $200,000. So
holy shit, yeah, that's a lot of money.
Yeah. As a real estate investor, I can think of a lot better things to put that $200,000 into than something that I can basically do from my phone with a few apps and property management tools.
So tell me what you're utilizing. How are you managing 8, 9 properties now in the short term? What's the process like? How do you get tenants in? How do you manage the maintenance on the properties? How do you keep up with the cleaning? Like, walk us through that.
Sure. So in terms of where you post your property listings to rent, you really only need Airbnb and VRBO. There are some other tools, but we get so booked from just those 2. We don't complicate our lives with further platforms. There's 2 apps that you'll need to be able to manage and streamline. Your first one is going to be your property management software. There are a lot of different ones to choose from. It used to be called Your Porter. Now it's called Guesty for hosts. There's another one called OwnerRez. There's another one called IGMS. They all do basically the same thing, which is they pull all of your listings on all the platforms into one dashboard so you can manage everything really easily. And the most important thing that they do is they automate a lot of the communication with guests. So you set up your automations to make sure that they're answering all the FAQs that a guest could possibly have before they even ask it. It's automatically sending their door codes and check-in instructions the day before check-in, automatically sending the checkout instructions the day before checkout. So that automates a lot of it. It also automates your cleaner. So it will sync with whatever calendar app your cleaner is using, Google, iCal, etc. And when someone books on any of those platforms, it automatically puts an event on your cleaner's calendar that says, hey, you have to clean this day. So that automates. And then you also need a pricing tool. So we use Price Labs. There are a few other ones, Wheelhouse, Beyond Pricing, and that is going to optimize your pricing. So that tool is always analyzing past booking information, current booking information, prices, events happening in the area, so that it's dynamically pricing you to get you the highest amount possible per night that you are able to get.
That is very cool, because we had a lot of short-term rentals, and we had a company that was doing it for us. They didn't manage per se the property, but they managed the booking part. They took 10%, and they said that they had an engine they created that was dynamically figuring out what was the best pricing schema. And we were always booked when we had these properties, but I don't know. This is actually really good information. You're giving me a ton of I'm loving this podcast because I'm learning. Okay. I don't usually learn a ton of the podcast, but I'm really learning a ton from this conversation.
Oh, so good.
Yeah, this is good stuff. So, all right. So you automate it with, you said one of them was like communication with the guests. It's automation. It automates everything, which is Guestily, you said?
Guesty. Yeah.
Guesty. Okay. Price Labs,
it's just
Beyond
called
Pricing.
Yeah. So just a property management software, which is the Guesty, IGMS, all that stuff, and then a pricing tool.
Yep.
So two things.
And then so you have your cleaners automatically in this. What about maintenance issues, pictures? Like, does your cleaner come in and take the pictures and make sure everything was good after the people left, or do you have another person that comes in that does the checks to make sure that nothing was broken, nothing's missing?
Typically, your cleaners will be your eyes and ears on that kind of thing. And if they see anything that's broken or needs to be replaced or anything like that, like, hey, your towels are getting ratty, then they'll let you know. And then if it requires calling a separate vendor, like a handyman or HVAC technician, whatever, then that is something that you kind of have to jump in there and make the phone call. But a lot of people mistakenly think that they need to live like driving distance from their short-term rentals in case some of that stuff happens. But I mean, if something breaks, like if a toilet breaks at my place in Tennessee, I'm going to do the exact same thing as if a toilet breaks in the bathroom behind me. I'm going to call somebody because I don't fix toilets. So it's just kind of a mindset thing of, even if this was right here next to me, I would still be making a phone call. If it's in Tennessee, I am also making a phone call.
I love it. So let me ask you, with the scaling of the 8 or 9 properties that you did you bring in any private investors to marry them with straight financing in the front to scale this thing? Or is it
sure.
Talk about that.
Yeah, so I'll tell you exactly how I did it. So the very first one that we got was a 10% down vacation home loan in my husband's name. Second one was a 15% down conventional investment loan in my name. And on that one, I cashed out my 401k because I had been working in my corporate job, not terribly long. There wasn't much in there. Third one was a 15% down investment loan in my husband's name. We go back and forth. You can see a pattern here. And on that one, we got a HELOC on our primary home at the time. So we used that for the down payment and then paid that back basically immediately. And then on the last two, we were out of DTI, which is what you run into eventually with conventional financing. So we brought in a partner, and the way that we structured that, so he was a friend of ours that we actually met drinking margaritas on a cruise. And he owned short-term rentals in Siesta Key, Florida. So he was already familiar with the business, was kind of intrigued by doing it in the Smoky Mountains. So we did a standard money person, sweat equity person partnership. So he got the loan in his name and we did all the setup and all the management. We had what we called a mini mortgage with him where we were paying X amount to him per month until what would have been our half of the down payment paid back. And then it was a straight 50-50 from there. So we're doing all the management and he's just collecting the money, splitting it 50-50. So we did that on the last 2 of those first 5. And then about 2.5 years later, we were ready to get out of that partnership, not because it went bad, it was great, but we were just ready to move on. We didn't need the quote training wheels anymore. And we were able to 1031 exchange our buyout proceeds into a bigger property on that. So now we have a bigger short-term rental instead of those 2 smaller ones.
Real nice. Very creative too, by the way. He put up all the money, put up the down payment, put the loan in his name, and then over X amount of time frame, you guys paid him back to make you guys equal for the down payment. Very creative. Love it. Yeah. That's your mortgage background.
Yeah.
For sure. All right, let's switch gears now. You have how many long-term rentals in your portfolio?
So as of right now, what we have closed is 105 doors and 8 of those are short-term. So that's 97 long-term doors.
97 long-term. And you said you have another 40, 50, or 60 in the pipeline that you're going to close over the next X amount of months?
Yeah, so we have a 68 unit deal. We have 1 short-term rental, and then we have 7 duplexes under contract right now.
All right, so talk to the audience on how you scale that part of the business with that many doors in that short amount of time frame. What was your process? What did you do?
Well, the number one thing you don't do is you do not live off your short-term rental income. So this is not a strategy that there's a lot of short-term rental educators out there now. They're like, oh, you can quit your job off 2 or 3 properties. Yeah, you can, but then you're stuck with 2 or 3 properties and that's it. Like you're going to have a really hard time scaling. So we kept our jobs, just kept throwing more money at it. But the main thing is we did not spend the money we were making on real estate on anything other than real estate. So it was not like extra vacation money or babysitter money or anything like that. Everything we've ever made on real estate has gone right back into real estate.
Smart, very smart, yeah. Avery. Yeah.
So the more the more properties you get, the faster the snowball starts to move. So it started with, okay, we have some extra money. Let's pick up this $100,000 duplex in Chattanooga. Oh, cool. We can pick up another $100,000 duplex without really even noticing it in the bank account. And then all of a sudden we had 10 of those and we're like, all right, so what's next? Oh, you know what? There's enough cash there now that we can buy this 12-unit apartment building for $750,000. So it just kind of has gone from there. The more of a nest egg you have, the bigger property you can buy. You don't have to start buying bigger properties. But that's just kind of the way we went with it, because we got to a point where we're like, okay, now we have 15 single family doors in Birmingham. It would probably just be easier to get one 15-unit apartment building than to just keep buying all these single families. So Right now we have kind of our 3 machines running, and do not do this right at first or else you will never buy anything. Start with one strategy, but we're still buying short terms if a good deal pops up. We have our single family value add machine running in Alabama. So we just kind of pick those up as we go. We're averaging like about 2 or 3 a month. And then we have our multifamily machine running in the Midwest, just kind of keeping an eye on anything that makes sense there.
The single family side and the multi side, are you bringing in partners on those? Are you bringing in equity partners? Are you syndicating, or is that just 100% all you and your husband?
Just myself and my husband. We have when we started, I put us on a $20 a day budget each. So, I could do a whole other podcast on just budgeting to get to this point, but we started with like nothing, with having this to save for a year just to buy a $120,000 house. So I've just kind of employed those same strategies, but on a larger scale, so that we have not had to bring in any partners.
Avery, you're very smart with your money. You're following the concepts that a lot of people, they preach it, but they don't practice it. And you're like, budgeting, number one. I was never a good budgeter, but budgeting is extremely important. I've always used to, because I always had it, so I would just put it out. But if you don't budget and you're on a tight budget, you're not making enough money, you have nothing in the bank, you have to save to reinvest. You did another smart thing where you plowed every single dollar for your investments back into real estate. You didn't live off it. You didn't go buy fancy cars. You weren't on the internet flashing your Mercedes or your BMW. You plowed the money back into your real estate. 5 short years, you guys amassed a really nice size portfolio. So congratulations. And you did it on a shoestring budget, starting really from scratch.
Right. Yeah. Started from absolute scratch. Thank you.
Congrats. Honestly, congrats. Really solid information. So talk about your book. What's the book about? I know what it's about, but let's go into the book for a second.
So the book is called Short-Term Rental, Long-Term Wealth, and it is actually part 1 of a 2-part. The next book will come out next year sometime. But it's a basic overview of how to identify a market, how to find an agent, how to find a deal, how to analyze a property. And then the second half of that book is about the remote management. So I've got a lot of experience, not only with our own short-term rentals, but with the short-term shop. So like I said, we operate in 11 markets, and we have helped over 5,000 families acquire cash flowing short-term rentals. So I've kind of seen it all over the course of my career with short terms. So the book is all about how to get started with short terms.
Love it. And the podcast?
It's called The Short-Term Show. We interview a lot of short-term rental investors, or people like CPAs, tax attorneys, anybody who would have good information that listeners want to hear about, like, oh, how do I set up an LLC? When do I set up an LLC? So different guests every week, typical podcast format, but it's all related to short-term rentals.
Boom. Avery, if people want to get in touch with you, how do they find you? Where do they go?
You can find me at theshorttermshop.com or on Instagram at theshorttermshop.
Love it very much. And again, I appreciate you coming on. Sorry for I had to put you off the last time. So thanks for being really kind about that. And honestly, you've really brought in some great value today. I know the listeners, if they're getting into short-term rentals, you crushed it. You gave them some really good tools. And this whole podcast is about us giving certain tools, tips, tricks, strategies, and secrets from what I've used and my guests use. And you brought it today, Avery. So thank you very much.
Thank you so much for having me. Happy to do it.
Yeah, I'll see you on the next one. Take care.